Equity method. For the investment in associate or joint venture, it is initially recognized at cost, while the carrying amount is increased or decreased based on the investor's share after the acquisition profit and losses of investee. The shares of investor's profit and loss in investee will be recognized in investor's own profit and loss. These changes of carrying amount also include that of investor's share of changes to that of investee's other comprehensive income. The changes will be recognized in investor's other comprehensive income. However, the incurrence of dividends and other distribution will have an effect on the carrying amount of investment. Carrying amount of investment in associate or joint venture is disclosed as non-current assets unless the investment is classified as held for sale. In accordance with MFRS 5 of the non-current assets held for sale and discontinued operations. Impairment at cost. Add. Post-acquisition reserves. Less. Dividends. Less. Impairment of goodwill. Equals to carrying amount. Financial year end. The most recent financial statements of the associate will be used to account for the result of operation and financial position of the associates involved. In terms of different financial year end by the associate, a financial statement bearing the same year end with the investor shall be prepared. Accounting policies. When there are different accounting policies being used by either parties involved, the investor will have to make necessary adjustments to conform the accounting policies of each other. Cumulative preference shares. Investee's profit of the year has to be adjusted for dividends for the year due to the cumulative preference shares. This is in spite of the dividends are declared or not before the residual profit of the year is allocated. Losses. In case there are losses incurred, and by mean the investor's share of the losses equals to the investor's interest in investee, hence the investor do not need to recognize further losses. The carrying amount of the interest in the investee will be nil. Exemptions from applying the equity method. There are certain conditions whereby applying equity method can be exempted. First is, when the investor is being exempted from applying equity method since it is the parent that is exempt from preparing a consolidated financial statement. Or, when all of the following apply. Entity is a wholly owned subsidiary or partially owned subsidiary while at the same time other owners are informed and no objections. Debt or equity instruments are not traded in public market. Entity involved did not file or plan to file financial statements with regulatory authorities. Ultimate or any intermediate parent of the investor produces consolidated financial statement. Investment is classified as held for sale in accordance to MFRS 5.